So today I'm just going to take a closer look at two of those, the capital assets and the long-term debt. So that's what the presentation will be here this morning. So just a little bit about myself. Again, my name is Kevin Stouffer, a member of the firm. I've been here just over 16 years, starting back in 2014. And I'm a member in charge. Again, what I work on is primarily local governments throughout the year. A little bit about me personally, just a big Orioles fan. Right now I have my Orioles tie on. They only have one loss and it's July 29th, so that's a positive note. But I'm a big sports fan, and I just heard this morning with so many sporting events being canceled, they're going to televise the World Origami Championship, but it's only available on pay-per-view. That's my one joke. I promise no more terrible jokes, but I had to fit one in there. So as far as the footnote disclosures that are included in the financial statements, again, what is the ultimate purpose of those? And again, that's ultimately to present both quantitative and narrative information that's essential to understanding the financial statements themselves. A lot of times, ultimately, those footnote disclosures are helping to communicate or comprehend the information that's trying to be reported within the financial statements. So again, it's just kind of taking the information that may be already presented and just helping to further clarify those or provide additional analysis or information to ultimately understand those. There's three different types of footnote disclosures. The first one is just pretty general, and it goes through the accounting methods, policies, and choices that are ultimately underlying the amounts in the financial statement. So we'll get into some examples shortly, but that's typically note number one. That's the summary of significant accounting policies. And that just kind of describes kind of the what or the how information is ultimately recorded. There's also information that provides details or explanations about the amounts that are presented in the financial statements. So a lot of times the financial statements themselves, they may show a dollar amount, but not really have a whole lot of explanation or detail. It's just, for example, capital assets, and here's an amount. The footnotes are ultimately going to provide additional details and explanation for those pieces of information that are reported. The final type of footnote disclosure, again, not quite as common, but we do still have these. But basically, if you have something that, as far as presentation is concerned, that would meet the definition of a financial statement piece of information, but wouldn't necessarily meet the criteria to be recognized. So the most common example that we have there is a subsequent event. Sometimes after year end or after the balance sheet date, debt may be issued. So that's important to the reader of the financial statements to understand that. It's not accounted for, it's not reported in the financial statements, but again, it is important to the reader of the financial statements to know that that subsequent event occurred. So again, those are just some high-level details of what the footnote disclosures are as far as that is concerned. As far as the methods, policies, and choices, again, this is just a little bit more detail here as to what's typically included in the summary of significant accounting policies. And I think a lot of times a reader of the financial statements, you want to be able to answer the question, how did the government come up with these numbers? And that's ultimately what that note number one of the summary of significant accounting policies is used for. And it's very important to explain that as far as the methods, measurement, and reporting of transactions and events. It's not a one-stop shop. There's a lot of different options that governments have as far as reporting information. And this note number one just kind of describes those methods and policies and the choices that the government ultimately made. The couple examples that I included here for today's presentation, as I mentioned, I'm going to cover capital assets and long-term debt. So as far as the choice is concerned for capital assets, the useful lives are ultimately a choice that the government has to depreciate those capital assets. So that's individualized for each governmental entity, and also including details of long-term debt. When it comes to the debt, there's a lot of information that's included there. Again, in the financial statements, it may just say long-term liabilities. Again, the footnotes ultimately describe that information and how that information is reported within the financial statement. So again, note number one is pretty much high level, just kind of describing how the government ultimately came up with those numbers. So we're going to dive in now as part of the capital asset disclosures. And you can see here, again, I'm just going to start with note number one. Again, note number one covers all footnotes, but the portion that's related to capital assets, I'm going to cover here on this slide and the next couple slides. So first and foremost, you want to define what a capital asset is and ultimately where these are recorded. So most governmental entities are recording under the full accrual basis of accounting. If you have governmental funds, they ultimately roll up into government-wide statements. And if you also have proprietary funds, or maybe you're an authority that only has proprietary funds, those are also recorded under the full accrual basis of accounting. So both the government-wide statements and the proprietary funds are reporting under the full accrual basis of accounting, and therefore those capital assets are reported in each of those statements and funds. On the contrary, your governmental funds are currently not reporting the capital assets. So note number 1 defines where those are reported, and ultimately any purchases that are capital related in a governmental fund, and in other words, your general fund, are ultimately expensed and not capitalized and depreciated over time in those governmental funds. So note number 1 just kind of lays that out and kind of sets the direction of where the information for the capital assets are ultimately recorded. Another reminder when it comes to capital assets that are recorded in the financial statements, they are recorded at historical cost and ultimately depreciated over time. I know a lot of times when we present to boards, I like to clarify that. I know sometimes they may think, well, what's the fair market value of our capital assets? And as part of the financial statements, that amount or that disclosure is not included anywhere within the financial statements. The capital assets are ultimately recorded at historical cost and depreciated over the useful life. We also go through the method of depreciating those capital assets. Unlike the for-profit world, there's no real benefit to having an advanced depreciation. Again, obviously being a governmental entity, you're not paying taxes, so there's no real benefit to ultimately accelerate the depreciation on those capital assets. So for the most part, most governmental entities, they ultimately choose to depreciate those capital assets over what's called the straight line method. And ultimately, if you have an asset that's going to be used over 10 years, you just take 10% of that, and that's the depreciation over that estimated useful life. So 10% on an annual basis. Also included in the summary of significant accounting policies is just a capitalization threshold. That just helps management ultimately determine what items will be capitalized and sets a dollar amount. So that way, as a governmental entity, you're not looking at every $200 purchase per se, even though it may be used more than 1 year. This just sets that threshold to ultimately delineate between what will be capitalized and what will not. Furthermore, on the next slide, it just goes through and defines the maintenance and repairs that are ultimately not depreciated. I know a lot of times throughout the year, I sometimes get questions, should this be a capital asset? Should it not? And I think the ultimate question that you have to ask is, does this extend the life of the asset? And if it's ultimately extending the life of the asset, then it should be capitalized. However, for the most part, if it's just considered a routine repair or maintenance item just to get it to its original estimated life, that would be considered a maintenance or repair and ultimately not depreciated. Previously, under GASB standards on your proprietary funds, certain interest costs were capitalized and included as part of that capital asset. Now all interest costs are expensed. So it's typically a disclosure there just to clarify that as well. And then also included in note 1 are the details of the useful lives. So you'll see a lot of examples that I've pulled here from several of our governmental entities. This particular one was a school district. And you can just see they had both capital assets and their governmental activities as well as their business type activities. So this just breaks down those major classes and what the estimated useful life is for each of those. So you can just see that that's a disclosure there that's included, note number 1, to define what those useful lives were. Once you kind of get past note number 1 or the summary of significant accounting policies related to the capital assets, ultimately there is a footnote disclosure required for the capital assets and to ultimately provide additional details as it relates to those capital assets. So some of those requirements that are included to be there are first to segregate the major classes of capital assets. And again, you want to segregate out the amounts between governmental activities and the business type activities. On the financial statements, those are 2 separate columns. So similarly in the footnotes, you want to segregate those as well. Also segregated out are the capital assets that are not being depreciated. So the 2 common examples that we have are both land. Obviously land, it kind of doesn't change. There's nothing to depreciate there associated with that. So land is not depreciated. And similarly, construction and process or CIP is also not depreciated. Until an asset is actually complete and placed in service, you don't begin that depreciation. So basically you accumulate all those costs associated with that project. Once it's complete and placed in service, then you begin the depreciation on those capital assets. So once you kind of get past the narrative of the certain pieces there of the capital assets, you do get into the disclosure there that's typically shown in table format, and it just breaks down the major classes of the capital assets. And then you can see the four components that are required there, beginning and ending balances, again, with the accumulated depreciation split out separately from the historical cost. What I'll say next are typically the additions and reductions. Those are typically your acquisitions and your sales or other dispositions. So kind of a table to just show all the activity for the year. And then finally, a required disclosure if you're a governmental activity to show how the depreciation expense is allocated. And ultimately, they're allocated amongst the different functions within the statement of activities. So I'll get to a couple examples here shortly, but just wanted to explain what was required. So on the next slide, it just gives you that breakdown there of the capital assets. And again, a little bit of the requirements there of the specific details showing that annual activity, allocation of depreciation expense. And again, you also have the option to break down further the construction of progress portion of that. So on the right-hand side is just a sample from one of our clients. Again, you can see on the top portion, that's split out between governmental activities. The bottom couple items there are your business type activities. And I'll focus obviously on the governmental activities. You can see the difference there between the cost perspective. And again, the top there is the cost perspective and the bottom is the accumulated depreciation. And then the cost is broken down once again between the assets not being depreciated and those that are being depreciated. And then again, each of the individual columns show your beginning balance, the acquisitions, your reductions, and your ending balance. And sometimes when you look at the total additions and deductions, you kind of have to, if you want to look at the true activity, sometimes you have to look at the deductions of your construction and process because they are included as additions on another column. So you can see for this particular example, the full deduction amount of the construction and process, the $5,713,000, is the exact addition to the buildings. So the true additions for the year, you'd basically have to back that off of the total additions. So those additions were closer to $5 million rather than the reported $10 million that's included there. And then the bottom piece again is the depreciation, accumulated depreciation, the additions being the depreciation expense in the current year. And again, the bottom piece is just the business type activities. On the next page is just the allocation of the depreciation. Again, these are the functions that are used for the governmental activities. For a school district, obviously the largest majority of the activity is within the instruction to provide instruction to the students. So that's where the majority of the depreciation is, but obviously can have other functions as well. And this particular client, again, at the end of the year, didn't have large construction in progress, but you can also show the details there for the projects that are ongoing as of the end of the year. Next, I'll just turn your attention now briefly to the liability section, focusing primarily on long-term liabilities. Again, very similar information in note number 1 related to the summary of significant accounting policies, and you're ultimately going to provide specific details of where these liabilities are recorded. Similar to the capital assets, these are recorded on the government-wide statements and your proprietary funds, and those liabilities are not reported within your governmental funds or your general fund for that matter. You also have to go into detail regarding the recording and presentation. In the statement of net position, there's a couple additional items that are related to debt, and those include bond premiums and discounts, deferred charge on bond refunding if you have a refinancing, as well as prepaid insurance costs. And then also you have to include the details of how the information is reported in the governmental funds. Similar to the capital assets, if you make principal payments, that principal payment is an expense in the current year. When you issue debt, it's considered another financing source and use. So on the next slide, I'm certainly not going to read through this. This is just an example that we have here. For the summary of significant accounting policies, it just kind of describes where the information is reported within the financial statements, and again, liabilities and deferred outflows, as well as assets for the prepaid insurance, and once again, the income statement impact on those items within the governmental funds. So there's also, for the long-term liability, specific details of those liabilities. Again, those typically include bonds, notes payable, capital leases, compensated absences, and you can also have claims and judgments. The disclosure of the activity is very similar to the capital assets. It's also in a table format, again, showing the beginning and ending balances, increases and decreases, the principal portion that's due within 1 year, as well as which governmental funds have been used to liquidate the other long-term liabilities. So typically that's the general fund, but if you have a capital reserve or capital projects fund that's making those debt payments, you may have to disclose that as well. And then a recently required disclosure is to include the bonds and direct borrowings, is to segregate those out within the financial statements or in the footnote disclosures. As far as the specific details, again, as you issue debt, there's some information that's required there related to the interest rate, maturity dates, and any pledged assets. If you have any letters of credit or unused lines of credit, that's also a required disclosure in the financial statements. And also required disclosure is to have the default provisions. So if you were to not make a debt payment, what are those default provisions related to that debt? And typically there's acceleration clauses on that. Finally, if you have a refinancing that occurs during the year, you have to show what's known as the cash flow and economic gain of that refunding. So similarly, I just included a slide here for other short-term liabilities. Again, these are very similar to long-term liabilities. I included it here in case any governmental entities, haven't seen these too often in the past several years, but could be more common here in the current year is what's known as a tax revenue anticipation note. And there's just requirements related to that to show the beginning and ending balances and additional details for any short-term liabilities that were issued and paid back during the year. So the next slide is just a table format. Again, looks very similar to what we looked at for the capital asset. Again, you're seeing a breakdown on the left-hand side between the bonds and what's known as direct borrowings or notes. Then below that, you can see the compensated absences for vacation or sick leave that are paid at retirement. The example that we have here includes a retirement incentive, and you could also have capital leases that are included as part of this table. The example I had just didn't break that out or didn't have a capital lease. Again, you can see the columns, beginning balance, additions, no debt issuances this year. The reductions are the principal payments that were paid during the current fiscal year, coming up to the ending balance, and then the current portion that's due within 1 year, and the long-term portion that's due in more than 1 year. And again, these amounts obviously tie back to the financial statements and the statement of net position. So finally, that we have as far as the long-term liabilities, again, specific details of those long-term liabilities. This is just an example for that particular one. The tick mark A there was the first bond issuance, and you can see the total amount that was issued, the maturity dates when the bonds come due, and also what the interest rates were related to that debt. If you do have a refinancing, once again, you have to show what's known as the cash flow gain of that, which is the difference in the old debt service to the new debt service, less any bond issuance costs. So ultimately, the cash flow related to that, and then also taking the present value of that cash flow gain is a required disclosure. So typically, that's not something that we're coming up with or that you're coming up with. Typically, that's provided as part of the bond documents and ultimately a required disclosure. And then the next example that I have is just some default provisions that we have here. Once again, if the school district were to not make your debt payments, typically there's ramifications for that. And basically, all the bonds could be callable, or the payment from the Pennsylvania School Code or the Commonwealth of Pennsylvania could be withheld related to that. So another required disclosure are also the future maturities. Again, it's just splitting out the bonds and the direct borrowing separate. And this shows both the principal and the interest perspective. So that's obviously everything we were looking at previously was just the principal components. From a cash flow perspective, obviously there's interest payments to be made related to the debt. And this just gives you that breakdown between the two. The next slide is just a quick example on capital leases. Again, just a little bit more information there as far as the future payments are concerned, less the interest payments, that's the principal that's due, and also ties it back to the capital asset value. So again, just a required disclosure there for capital leases, and Tina, I think, will be covering that change for leases in the future, but for the current time period, that's the required disclosure related to that. Related to capital assets and liabilities are also what's known as commitments and contingencies. So these are typically a separate footnote, but a commitment is any signed contract that's not yet completed, and maybe all the costs aren't yet incurred. But just wanted to highlight there that is included there for the commitments and basically to show what is signed and required. Any contingencies that are recorded, maybe any pending or threatened litigation are related to those liabilities. Again, that's a required disclosure as far as your footnotes. From an auditor perspective, obviously, we typically help to identify these and to record the footnote information. The commitments and contingencies are a little bit harder because that's typically not recorded within the general ledger. So I also included here just an example of commitments that you may have. Again, this one just breaks down the total cost incurred, and the amount yet to be incurred as of the balance sheet date. So that's just a quick example for what's included there related to commitments. And then I also have a quick example here for contingencies. Obviously, school districts typically have tax appeals. Again, that's kind of routine. So this is just kind of a generic disclosure that we have as far as tax appeals and any pending threatened or litigation. So I'm running out of time here. I just wanted to briefly touch on subsequent events. Again, that I mentioned earlier. Again, those events occur after year end, but are related to the previous year, that happen after year end, after the balance sheet date. And you just want to provide that information to the readers of the financial statements. And then I just have an example there for you of what that could look like. Again, far less in detail, but that way the reader of the financial statements ultimately understands that information. So just in summary here, again, I had these slides in here last year, but just how to make sure everything is disclosed. There is a disclosure checklist that we use. We just recommend providing that to our clients if you're unsure. We can use that as a resource tool, and also looking at the general ledger as well as board minutes to make sure that everything is recorded as required. Just in summary, again, there are specific disclosures that are required, but if not disclosing a piece of information would be misleading, you do have the option to include that as part of the footnote disclosures. So just in summary, again, it's very important for those disclosures to be included. There are specific requirements to be included there, and we just recommend to kind of work hand in hand and ultimately communicate those with your auditors as the financial statements are being prepared. So I apologize for rushing through the last couple of slides there, but again, similar to Bill, I'll certainly respond to any specific questions that we have after the session here today.